Hello, everyone, and thank you for joining our Hum Capital webinar series. Our next webinar called Leveraging a Financial Model to Close Checks in partnership with Forecastr, a Hum Capital partner. My name is Brandon Bell. I'm our digital marketing manager. And just to give you a quick overview of the webinar, what we're going to be discussing today with Forecastr is how to build that financial model during fundraising, specifically what investors are looking for kind of during the fundraising process, and then ultimately how to present your model to investors in the process. And I'm really excited to have Logan Burchett, Forecastr's co-founder and COO, to walk us through a presentation to kind of answer all those above questions. And just a quick overview, if you're not familiar with Hum Capital, we are a fundraising platform. And our fundraising platform, the Intelligent Capital Market, is a fundraising platform that via data analytics and AI and machine learning, we connect companies who are raising capital to investors and lenders. So in the recap email that we'll send out, we'll send a link to get in touch with us if needed. And then without further ado, I will hand it off to Logan to walk us through. And thank you again for being here.
All right. Well, thanks so much for having me. Yeah, and thanks everybody here for joining. I'm really excited to be talking to you all about how to use a financial model for fundraising. And this is a topic that's very near and dear to my heart because whenever my co-founder Stephen and I originally raised money for Forecastr, we had basically no traction. We had no revenue, we had no product, we had nothing. We just had an idea, we had our backgrounds, and we had a really great financial model to tell the story of how we wanted to grow the business. And we leaned really, really hard on our financial model. Since we didn't have a product or revenue, we had to find other ways to de-risk the investment for potential investors. And we were able to do this by giving them confidence in our financial plan. It's our way of showing them that we were going to be good shepherds of their investment. And it was also a good way to show them that hopefully we had some idea of how we wanted to grow the company. I always say fundraising is really, really hard work. There's absolutely no doubt about that, but there are tools out there that can make fundraising just a little bit easier. And a great financial model is absolutely one of those tools. And my goal for today is to prove to you that it's one of the most powerful tools in your fundraising arsenal. And before I get too far into anything, I do want to give you a little bit of deeper dive into my background. So, as was mentioned before, I'm Logan Burchett. I'm co-founder, chief operating officer here at Forecastr, and I've been in finance for pretty much my entire career. So I started off my career working at the Kentucky Pension Fund, managing their stock portfolio. I eventually left and became a fractional CFO / head of finance for dozens of venture-backed startups. And this is really where I learned the ins and outs of financial modeling and honed my craft. And it's what led me to starting Forecastr, and even more importantly, it led me to my co-founder, Stephen, and you can see him here on the slide next to me. And between the two of us, we built well over 200 financial models. We've grown Forecastr to have over 400 clients. We both raised money from investors. Forecastr's raised about $5 million. And I'm a finance mentor at Gus, Techstars, NewChip, GSV Labs. Know the startup finance game better than most folks you're likely to meet. And if you're not familiar with Forecastr is an online software that helps founders build great financial models so that they can understand their numbers, make better decisions, and get funded. And I always say the heart of what we're doing is we're making forecasting easier and more meaningful for founders and investors because we love forecasting. We think that it's one of the most powerful things that you can do for your business, but we really don't like Excel, even though we used it professionally and we're deemed experts by many folks that we meet. But Excel's clunky, it's hard to learn, but above all, it's unstandardized. And that means that every model is different. So it's really impossible to compare yourself to others or automate data. And Forecastr strikes a great balance where every model is unique, but it is standardized in our platform. So that way you can compare yourself to cohorts, you can link up your data sources. It just makes you a lot smarter and more efficient. And we also have a team of experts that are going to help you along the way from the initial build of the model on through any ongoing questions that you have. So if you are interested in Forecastr, we will be following up with more information on how to get in touch with us, and we will offer everybody on here a discount. Just to touch on a very brief agenda for today, I want to talk about the power of a financial model, go over the things that make financial modeling great, helps you raise money, helps you run your business better. I want to talk about how to use a model in your pitch deck, how to specifically present your model to investors. And then we're going to go through a real world example. And that's where we're actually going to dive in to Forecastr's own financial model. And I can walk through how I typically present my financial model to investors. Now, I do want to make sure that we're all on the same page of what exactly a financial model is. And this may seem like a very basic question, but if you ask 100 different people the question of what is a financial model, you'd be surprised at how many different answers you're going to get. A model has many different functions and thereby has a lot of different definitions depending on who you talk to. You know, it can encompass things like an expense budget, a hiring plan, a cash forecast. It's a wide span of what a financial model can do. Now, the best definition that I've ever heard came from Troy Hennicoff. He's a former MD of Techstars Chicago, and he uses a really great analogy to describe financial modeling. And it goes like this, right? So back in the earlier days of the car manufacturing process, this is what the design phase looked like. It looked a lot like what you're seeing on these slides, where you'd have these people in these lab coats. They'd go in, they'd carve out full scale replicas of their designs. And then you would have to go and shape everything exactly how you'd like, and then build a working prototype of those designs. Now, once this prototype was built, you have to go find some really brave tester to jump in and test these machines that are completely unproven. And sometimes the prototype would work fine, and then sometimes it would flip over into a barrel roll while it was taking a sharp 90-degree turn. But the only way to know was to just build it. So engineers would have to create entire working cars just to see if their concept worked. A lot of times it didn't, and then it was back to the drawing board. And then you'd have to iterate over and over again and spend millions of dollars. And eventually you might have a car, but you might not. And pretty wild by today's standards, wasting a ton of time, energy, effort, and money, risking lives in the process in building these. And now we don't do that anymore because thank God for technology. Cars can be built can be built soup to nuts using software these days. So they can be designed and tested in minutes instead of months. You can build a completely virtual car. You can drive it on a completely virtual track, and you can take that sharp 90-degree turn virtually. And that way, if it flips into a barrel roll, nobody's hurt. You just tweak some components. You try again until eventually you get it right. And the idea of building on a full-on physical prototype before any software testing is just pretty laughable by today's standards. And we think that this is a great analogy for financial modeling, because in the same way, you can simulate your business and run tests in minutes instead of years. So you can see what happens when you add a new product line or try a new marketing channel, or if you invest in a sales force. And early on, you can even understand if the business is viable or if you need to switch up your business model entirely. So in a way, you're saying, can you handle that sharp 90-degree turn? Or are you going to flip over into a barrel roll? But this way, if there are issues, then nobody gets hurt, not you or your co-founders. And it gives you a chance to optimize before jumping in head first, wasting a ton of time and money. And when built correctly, you will have a completely distilled working simulation of your business, which can be one of the most powerful tools in your arsenal. Now, your model's going to hold answers to a lot of key questions. And a lot of these, I'm sure you've been asked before from investors. And I threw some of the more common ones up on this slide. So how much money are you raising and why are you raising that much? Founders usually have an answer for the first part of that question, but a lot of times they'll falter on the second part. You need to have a good understanding on your uses of capital. Otherwise, you look like you're fundraising without a plan. Who specifically are you planning on hiring, and what impact does that have on burn? Most of our costs are people. Everybody needs to be accounted for in your fundraising plan. How do you plan to grow the business? What specific actions is your team going to take in order to ensure that the investor has the greatest chance of returning a profit? Now, if your model's buttoned up, you can have really bulletproof answers to all of these questions. And every time you answer a question correctly, it instills confidence, and that's going to take risk away from your investors. Now, we're often asked by founders, when should we invest in a financial model? And a lot of times companies claim that they're too early and they don't have enough of their business figured out in order to adequately forecast. Now, in our experience, having a financial model at the seed stage and below is a separator between you and other startups. Now, investors don't necessarily expect a great financial model from you this early, And you can certainly get a round done without one. But that being said, standing out from the crowd is really, really important while fundraising, especially early on. Investors are going to see hundreds of deals a week. They're going to turn almost all of them away. So your best chance of success is to try to eliminate all possible areas of risk. And financial risk is certainly real in early stage investing. So I already shared our story about how we leaned on our financial model at the pre-seed stage to get our round done. We've also had several seed stage customers that have told us that investors are committed after seeing their financial model. It's a great way to stand out and build confidence, which is really important while fundraising. At the Series A and beyond, though, a great financial model is completely table stakes. You got to have it. There's really no way around it. You're going to have to present your financial model during due diligence during the Series A. So our advice is to invest the time and the energy early on, because it's going to pay a lot of dividends later on in your business. Now, I want to get into how to showcase your model to investors and go over the method for looping your projections into the conversation and using it as a tool to further the relationship and continue to build further trust. Now, I'll point out, for this presentation, we're going to assume that we already have a great financial model built. Now, if this isn't the case for you, we'd love to chat with you more about Forecastr, so please apply for the beta. Or if you want to go at it on your own, we will make sure that we send out some templates during the follow-up that we put together that are going to be super helpful. But I want to start by talking about how to use the financial model and the projections in your pitch deck. Now, the key to showing projection slides in the deck is to keep it high level and not go too deep in the weeds. And by this, I mean, the very concise 10-slide pitch deck that we're all familiar with, right? Just the tight pitch deck. Now, this is a sample of our financial projections that we used in our deck during our pre-seed round. Now, the goal of this slide wasn't to convince investors that we had the greatest financial model in the world. We were really only trying to show them that this business can be really big. And essentially, we wanted to show them that we have an opportunity that's worth paying attention to. And we want to keep it really high level. We do that for a couple of reasons. One, the initial pitch should be focused on getting emotional buy-in for the company. Now, you want the investor to get excited about the opportunity, so you need this time to sell them on your vision. And if the investor isn't excited about your company, there's no point in digging any further. Remember, this is an intro conversation that we're talking about. So you got to get the emotional buy-in first. Second, going too deep into the numbers too early is going to lead to number fatigue and analysis paralysis. It's likely either going to cause the investor to shut down and lose focus completely, or it's going to lead the conversation off track into like deep financial specifics, which is not a route that you want to go too early either. And remember, initial pitch meetings are not meant to be a deep dive into the economics of your company. And if you focus too much on it too early, you're going to burn a lot of time. But the third and most important reason for this is that you want to use this as a hook to get that next meeting. You want to use these slides as the hook to get that next meeting. So whenever you put numbers in a slide, like the slide that we just showed you, savvy investors are going to want to dig in more and understand how you got to them. Now, this is your chance to set up a time specifically dedicated to this, which leads to more face time with the investor, which leads to more trust. Now, those of you who have fundraised before know that it's a game of building trust. Investors invest in founders that they trust, and trust is built through familiarity and confidence. Getting the meeting to go over your financial model builds both of these things. So another meeting with your investor leads to greater familiarity between you and the investor, and going over your financial model is going to build confidence that you know your numbers and you're going to be a good fiduciary of their investment. So it's really just this hook of trying to get that next meeting and using your financial model as a secret weapon to get that next meeting. That's the best way to leverage your financial model in these early conversations. But that's that first meeting. Now I want to talk about how to execute on that next meeting. And to be very clear, this is the meeting with the agenda specifically set to go through your financial model. And we recommend setting aside, at least an hour to go through everything here. But there are 3 time periods to look at with this meeting. May seem obvious, but it's worthwhile to kind of break them out like this. What you should do before the meeting, what you should do during the meeting, and what you should do after the meeting. So I want to break down each of these and look at them individually. So before the meeting happens, you don't want to send them a copy of your financial model. And people have very different opinions on this. We at Forecastr feel very strongly here. For the record, I feel the same way about pitch decks as well. So you don't want a financial model to live on its own. You need to control the narrative and present the model to the investor in person or on a call. And this is going to do a couple of things. So it's going to give you leverage to get that next meeting, like we talked about. If they're interested in your business and they want to dig in, they need to do that with you in the room. So that's kind of your leverage to get more face time with the investor. And we all know why that's important. Secondly, it's going to demonstrate your understanding of the model whenever you do present it. You know, showing your understanding of your model is showing an understanding of your business, because remember, the two directly translate. Your model is a simulation of your business. So if you can show them, I understand my model, it is signaling to them that you have a deep understanding of the finances of your business. But most importantly, it allows you to control the narrative. So when an investor first sees your model, they're going to react to it in some way. They're going to form an opinion on it. Now, you want to be there while that's happening so that you can control how that opinion is being formed. It's really easy as an investor to get the wrong impression of a model without context. Like it or not, once the initial impression's made, it's going to be super hard to get them to change it, even if the thing that gives them pause is very explainable. And this is just simple human nature. Once I formed an opinion on something, it's way harder to get me to change my opinion now that I've anchored somewhere. But it's relatively easy to guide where that initial anchor is being placed. So that's kind of the idea. So you want to be there to present your model, to control the opinions that they make on it. And when you're doing that during the meeting, you need to be in control. And this is important because people go into these meetings ready for battle. They think they need to defend their model against the big bad investor that wants to tear it to shreds. Don't let this happen. This is a working session where you and the investor are going to be working together. You're going to be using the tool. The model is a tool to analyze what you think is realistic for your business. So you're going to present what you think is realistic, and then you're going to have a discussion about that. If they have different opinions, you can model them out in real time. You can run different scenarios. You can also ask about their opinion, show that you value their input and their experience. And remember, it's a working session. So you're also showing the investor how well you can work together. So you're going to respond to their ideas. You're going to offer some of your own. You're going to present and you're going to brainstorm. You're going to kind of do those two things together. And if you do the prep work, if you know your model well, this really should not be a scary meeting at all. And it's always okay to say, hey, you know, I don't know. Let me dig in and get back to you whenever you're asked a really deep in the weeds question. Then after the meeting, you're going to want to follow up. Summarize what you talked about in an email, include a copy of the model then. So they're going to get their copy of the model eventually. And if they asked about a specific scenario that maybe you didn't get into during the meeting, then use that as an opportunity to run that scenario, summarize the outcome, send them a version of the model with that scenario. If they ask you a question that you didn't know the answer to, you can follow up after talking to mentors or advisors. You know, at Forecastr, we love helping founders answer tough financial questions from VCs. So open invite there if you decide to work with us. You know, if they said something that prompted you to do further analysis in the model, tell them about it, show them. It's a great way to earn brownie points. But ultimately, what you're trying to do is show them that the meeting was productive and that it meant a lot to you and that you enjoyed meeting with them. Okay, so now I want to spend a little bit of time going over a real world example with Forecastr. So I'm going to be diving into Forecastr's financial model and kind of going through the flow that we like to use here whenever we talk about presenting our financial model. So I'm going to go ahead and set this up by walking through kind of our version of our forecast that, you know, we're going to be using and that we have used while fundraising. So typically the flow that I like to use whenever I'm doing a deep dive into my financial plan with an investor, I call it the zoom out, zoom in approach, right? So I start zoomed out by looking at the opportunity of the business, by looking at a high level, why the investor should even care about the conversation. Why is this business going to be interesting? And from our standpoint, you're showing that kind of steep revenue trajectory, that venture fundable revenue trajectory. So we have us going out to 92 million in 2027. You can kind of do some rough math there and see that that's projecting us to be roughly unicorn status. That's what we like to see. That's what we're shooting for here at Forecastr. So we're kind of showing that trajectory of painting the picture for the VC. This is how we can become a unicorn. This is how we can get to that $1 billion valuation, and mapping the conversation all the way back from that endpoint. But I like to start at the endpoint just to get people emotionally bought in, to be excited at the conversation and excited about the opportunity. So start by zooming out, showing the high level economics of the business. And then I like to go and zoom in from there. So at that point, I'll switch to a monthly view. And then I will start diving into the assumptions that back up these projections. So in Forecastr, if you're not familiar with Forecastr, which I assume most of you are not, we have essentially built our platform in such a way that it's going to be really easy to walk through your projections with investors, because we like to walk our way down from that growth story. So I've kind of talked through, this is how big the business is going to get. And now it's time to talk about how specifically we're going to get there. I start by talking about customer acquisition. So I talk about the different ways that we plan on acquiring customers and how we plan on growing and scaling the business. I break it out into all of our different customer acquisition channels. And I'll start by talking about the status quo, how we're getting our customers today, roughly how many customers, what the breakouts look like, what the strategies look like. And in our case, we get most of our customers through webinars like this, through strategic partnerships, and working with companies like Techstars, which we're a Techstars alum. These are how we're getting a lot of our customers to date. And then I'll kind of parlay that into how we plan on scaling that and what we think the future of Forecastr looks like. And, scaling out here, I can talk about how our play is to really scale the other strategic networks in our webinars and like really dig deep into being thought leaders in the space. I can even, drill down into how many partnerships we're going to need in order to pull this off and walk through the assumptions that are backing this up. So if I'm looking at this by December of 2026, if we're, looking to go hard into partnerships, we're going to need, roughly 450, 460 partners actively referring customers to us on a monthly basis. And then I could start talking about how there's 4,000 accelerators in the US alone, and how, this is actually a very realistic target for how many customers we think that we can get, how many partners that we can get referring. And then I could talk about how the webinars are leveraging those partnerships, and we're co-hosting webinars, and how those two play together essentially to get us more leads. But it's walking them through kind of the thought process of how we're going to be scaling this. And this is really important, because if you just arbitrarily say that we want to be a unicorn or we want to be a $1 billion company, it's kind of hard to conceptualize and in some ways hard to believe. But if you can map it out like this, and you can break it down into the components and put in specific goals, then it becomes a lot more believable. Now, in our case, for example, right now, we're getting roughly 45 customers per month, between 35 and 45 customers per month. So this would just show over the course of, between now and the end of 2027, roughly 10xing our customer acquisition funnels, which is not crazy, given the fact that this model is showcasing us raising tens of millions of dollars. So kind of want to walk through that, make sure that we get people comfortable with our customer acquisition strategy. Then I flip into monetization, right? So I talk about kind of where we are today, roughly 1.1 million in ARR. And I talk about how we plan on scaling and monetizing our customers. So I can talk about our subscriptions and how right now we're seed focused and we just have a launch package. But eventually we're going to scale up and start doing a growth package, which is more Series A focused. That ACV is going to be a little bit higher. Right now our ACV is 2,000. That package might be 5,000. And then once we scale into Series B plus, our ACV is going to scale pretty significantly up to like 25,000. So it's kind of showing that we're growing with our customers and we're putting on more advanced feature sets. And then all the while offering them support packages on top of that. So analyst support packages that they can purchase, or CFO packages that they can purchase. So just kind of telling that story of how we're starting at the seed stage and then we're kind of growing up to the Series A and then Series B and beyond, and how we want to be the default operating system, FP&A operating system for the venture-backed ecosystem. And FP&A is financial planning and analysis, by the way. So kind of start with customer acquisition, then go into revenue streams. Then I like to make my way into people and show this is the team that we need to execute on this strategy. So we've deeply thought through who all we're going to be hiring and when we're going to be bringing them on. So you can like go through all of the positions that you've got that you want to put in to the plan. I talk about how we model out our analysts so that we have a ton of assumptions that back up to like how many analysts we specifically need that back up the logic and get them comfortable with the fact that we thought through how our margins are going to scale and how we scale up to those solid 80% gross margins that you like to see in SaaS companies and fully burdened gross margin at that. So we talk about the team that we need to scale. I'll briefly talk about the other expenses that we need to get there as well. So I'll go through all of the other stuff we need, like travel expenses, marketing budgets. I'll talk about our other cost of goods sold outside of people, but I typically don't spend a ton of time on this section just because usually most of the time people are interested in the people, from an expense standpoint. And I like to end it on the equity section just because I think it's important to always round it back to why you're having the conversation. So, at this point, I've shown you the grand vision of the company and what it looks like from a financial standpoint at its end. I've talked to you about our growth plan and what we need to do to get these customers and execute on that vision. I've talked to you about how we're going to be monetizing those customers once we get them. I've talked to you about the team that we're going to need to execute on this vision and some of the other expenses we need. And I like to end it here because I want to talk about why we need this investment, because none of it can happen. Everything that I just showed you that's so great, it can't happen unless we get funding. And this is why we need your funding. So, in our case, we've got, a $2 million WeFunder that we've talked about, and then a Series A of $10 million in here as well. So it's just kind of like us articulating generally what we think from a fundraising perspective that we need in order to execute. And I think that that's a really good way to walk through your financial model. I'll note here too, that this is just one scenario that we have. We have a bunch of different scenarios, but we recommend coming up with a scenario that you think is your most realistic scenario for fundraising, and then sticking to that scenario, and then having that be the true model that you use in fundraising and that you're eventually going to report against and show variance against and all of that. All right, so I'm going to loop back here, and I'm just going to end here before we open it up to see if there's any questions from the audience. But I do want to offer a 25% discount to anybody on this webinar that wants to use Forecastr. I mentioned it earlier, but it's typically a $2,000 price point. So we're going to knock $500 off that down to $1,500. We typically also, by the way, have a $500 implementation fee. We're going to be waiving that for everybody on this webinar as well. So that's essentially $1,000 off of your subscription. So anybody that wants to join, just $1,500 for folks that are going to be on here for the first year. Now that is going to come with 30 days of white glove onboarding from our expert analysts. They're going to work with you for 30 days to understand your business, build out a financial model similar to the one that I just showed you all in our software that's tailored to your business, and educate you on how to use the software for the first 30 days. After that 30 days is up, you can continue to use our analysts through just unlimited intercom and email support. Or if you choose to upgrade to analyst support packages or fractional CFO packages, we have those available for purchase as well, which are monthly packages that we can talk about onboarding. So if you do want to work with Forecastr, again, we'll follow up with a link to apply to the beta. Just let Mitch or Megan, our sales team know whenever you meet with them that you came to us through this webinar. We'll be sure to apply that discount for you all. But with that, I will open it up and see if there's any questions.
Awesome. Thanks, Logan. Yeah, I've been looking through the questions chat here. We don't have any yet, but now's a good opportunity to let folks know. Now is your chance. Pick Logan's finance brain. If you guys have any questions, go ahead and drop them in the Q&A, and I'll be sure to toss them over.
We'll get
Awesome.
that.
I'll throw up while we're waiting. I'll throw up one because I always like to get your take on this. When you start thinking about like what from your model should go into your pitch deck, like what as a founder, what should I include on a pitch deck on like my finance slides?
Yeah, no, it's a great question. I always say keep it concise in the original 10, like in just the 10 slide pitch deck. I think if you're going to devote a slide to finance, which I think you should, it should just be enough to catch the investor's attention to the point where they ask questions about how you got to it. So I like doing revenue trajectory, like that steep revenue trajectory, but not going too deep and putting a ton of numbers on the slide or all of your assumptions or anything like that. Just enough for the investor to say, it looks like you're projecting a lot of growth. I'd like to understand what your logic is behind that. That's your hook to get that next meeting, like we talked about in the presentation. So if you're looking at those 10 slides, just a high level revenue growth slide, I think is really good to include. Now, what I will say that I do like doing is just for like emergency purposes or whatever, like I like having a deep appendix in your slide deck. So like our slide deck, for example, is 10 concise slides that tell the story of Forecastr. And then I think we have like 20 slides or maybe even like 30 slides in an appendix. That is literally just supporting information, giving the investors, anything and everything that they would ever want to know. In those slides, we do go a little bit deeper into unit economics and finance. But I typically like to have those conversations in person with them, just for all the reasons that we mentioned in the presentation, just to show that you know your stuff, build confidence, continue the relationship with the investor, all of that.
As we wait, Logan, I'll drop in another question for you. So, jumping ahead a little bit, let's say you're continuing the relationship and you get that second or third meeting. What, in terms of the financial model, do you now want to additionally bring into the picture beyond just that high level overview that you kind of ran through in that first meeting?
Yeah, no, it's a good question. I mean, so usually I like to go pretty deep in even that first meeting. Like I like that to be a really solid deep dive in the financials of the business. So like what I just presented on, that was a very abbreviated version of what that meeting would actually entail. In reality, I would go into all of the metrics, all of the assumptions. I'd go really deep into the weeds on customer acquisition, funnel by funnel. I'd walk through where our metrics are today, where we project our metrics to be, what they need to be in order to achieve that unicorn valuation. So it would be a pretty in-depth, I think, conversation in that first meeting. Like I said, I usually, like whenever we have those types of meetings, like to budget a lot of time for it. If you can get 2 hours with the investor, try to get 2 hours with it. Because what I've seen and what we've now come to know is that the conversion rate on those meetings, if you can get them, are incredibly high from a investment or an offer to get an investment in your company. So to answer your question directly, I don't think there's anything necessarily that I would share in the third deep dive meeting that I wouldn't in the first deep dive meeting from a financial modeling perspective. I would just say, if they're wanting to continue along down that path, a second meeting and a third meeting, it's really just like let the investor guide you. It's whatever they want, because at that point they're dragging you and they want to understand deeper, in the metrics of your business. So it's really led by them at that point, and you can just go wherever they're leading you.
Mm-hmm. No, that's a great point. So it's really, you want to be fully prepared as you go into that first meeting, even if you don't necessarily go through everything. So you're ready, for those next steps in those next meetings.
Yeah. So whenever we talk about fundraising, well, there's a quote that I may butcher right now, but I think it was Abraham Lincoln said if he had 4 hours to chop down a cherry tree, he'd spend the first 3 hours sharpening the axe, or some variation of that. The general purpose was you spend the majority of your time preparing essentially for the activity rather than just going right at it with a dull axe. And, that's a great analogy for fundraising, is that we even, call it sharpening the axe before a fundraise. That's getting your narrative together. That's beating it up with a bunch of mentors. That's working on your pitch deck. That's spending a lot of time thinking critically about your financial model and your projections and how you're going to articulate them, so that by the time you get to a point where you're in front of an investor, you want to be pretty buttoned up. You want to be, to the point where you show very well. And now that doesn't mean that you're going to have all of the answers and that every single question that they're going to answer, you're going to be able to, you're going to be able to answer perfectly. But that does mean that, you are buttoned up, you can present well, you do know, what you should present on that. So yeah, by the time you get to that meeting where you're going through your financial model, you should be prepared to go as deep as you need to.
So going deeper down the path, what does, and I think this is helpful too when you're crafting that narrative, what do investors typically do to your financial model in the due diligence phase? Like, are they actually going to take your model and play with your levers, or are they reverse engineering it? Like, how do they use that in due diligence?
Yeah, it's a great question. And it depends, right? Like it really depends. Lenders are going to use your financial model different than, VCs will. Private equity people are going to, use it differently. It just really depends. And angel investors are going to use it different than VCs. Generally at the highest level, they're at least going to want to understand the model and the mechanics of the model so that they can deeply understand your business model and they themselves can understand the drivers of your model. I would say some of the more advanced VCs out there, because I think specifically to this conversation, that's really who we're talking about, is really angels and VCs. VCs, the more advanced ones, are going to likely have some analysts run through some stress testing of your financial model. One of the great things about a financial model that's built well is that it gives you a roadmap to the metrics that matter and the metrics that don't matter. So you're going to have a bunch of inputs, and when done correctly, you can vary each input by 1% and see what revenue varies by. So you can literally get a stack rank of your most important metrics. It's one of the things that we help our clients with at Forecastr. So I can tell you right now, for our financial model, the most important metric for us currently is the number of partnerships that we're able to generate over the next 7 years. That's what drives the vast majority of our growth. So, an investor may want to stress test that and say, well, what happens if you come in 20% lower, 20% higher? How big or small can this get? And then they're going to run that through like a DCF or a discounted cash flow just to get a sense of like what's realistic for them. But it really just completely depends on the investor. But that's these more deep VCs that have teams of analysts that have time to go through and do all of that. Not every VC is going to do that. A lot of the VCs that invested in Forecastr didn't do that. And angels, a lot of angels certainly won't do that. They may just want to, use it as a tool to understand a little bit more deeply, about your business. Also depends on the stage as well. I'll mention that too, is, a seed stage investor and a Series B stage investor are going to analyze the financial model very, very differently. The B is going to be much more critical and probably much more hands-on in stress testing.
Cool. Awesome. Thank you. Yeah, I haven't seen any other questions in chat come through. So yeah, we'll give folks one last opportunity to pick the brain, unless Brandon has anything to kind of throw at Logan. Yeah.
Well, I mean, if we don't have any come through, don't worry, because we'll obviously be giving you the channels to ask those questions that you might not have at the moment or be ready for after the webinar, and all our recap information that we send out. So if you don't have them at this moment, we'll definitely give you the resources to be able to do so. So we'll give it, one more second, and then we can kind of close out after that.
Good.
Cool. So I think we'll close it out here. On behalf of the Hum team, Logan, thank you so much for walking us through. I think it was super helpful and insightful for startups and companies on the webinar to see a real life example, the financial model, and what all the different kind of channels that go through in order to create that when fundraising and meeting with investors. As mentioned, we'll be sending a recap email over the next few days, so look out for that. And in that email will be a recording of the webinar and some of the resources that Logan mentioned earlier from both Hum and Forecastr, as well as the discount that Logan mentioned on the call. And then, of course, some opportunities to get in touch with the respective teams at Hum and Forecastr. So again, thank you, Logan, for sharing your insights and letting us deep dive into the Forecastr platform. And thank you all for attending, and look out for that recap information and email. So thank you all.
Thank you so much. It was great to be here, and I definitely appreciate the time and the opportunity.